Let's take a look at the Chapter 5 computational exercises. So I have your ebook on the screen. Some of the problems I want to start are just right here. So remember what the topic of the chapter is. It's about corporations, and then when they dividend away their profits, how is that treated by both the corporation and then by the stockholders, the owners, who are receiving those profits. So we'll get dividends and distributions. The first one's pretty straightforward. It's Myrna Corporation, a calendar year taxpayer, has E&P of $32,000. The corporation generated no additional E&P during the year, and then on December 31, the corporation distributes $50,000 to its only shareholder, Abby, whose stock basis is $10,000. How is this distribution treated for the taxpayer? So remember what E&P is. It's earnings and profits. And the loose approximation of E&P is very comparable to your GAAP retained earnings. It's not quite the same thing, but it's kind of loosely the same thing. And it's up to the corporation to keep a record of what its accumulated E&P is, because that matters when we do these distributions to the owners. And so this chapter really just deals with closely held corporations. That's really what the previous chapter dealt with, Chapter 4, in the formation of corporations. So think of it from that perspective. It's a corporation, it's a C Corp, but it's not publicly owned. It's owned by just a few people. So it's not a stock that's trading to the public. A few people own it. Quite often it's a family. It used to be a partnership. Now it's a corporation. So just kind of keep that in mind. So it is up to the corporation to keep good records about what the E&P is, so that when the shareholders receive distributions, they know how to treat them. Okay, so that's kind of just the background for this particular question. So they have E&P of $32,000. They generated no additional for the year, so their E&P in total is $32,000. So they're going to give their lone shareholder, Abby, $50,000 as a distribution. And so for Abby, how is this treated? And so let's kind of think this through. For sure, the $32,000 is a dividend to Abby. Okay, so she's got that. That's $18,000 left over. Well, she has a basis of $10,000, so we'll reduce that $10,000 basis. And so that leaves $8,000 left over, and the $8,000 then is capital gain to Abby. And so I'm going to just kind of put that in Excel here real quick. So dividend is simply just the $32,000. And then I'm going to call this ROC, and that just means return on capital. So ROC of $10,000, just her basis that she gets back. And the difference, we have to get down to $50,000, is capital gain. So that's the difference of $8,000. And the sum of these have to be the $50,000 distribution. So that's why I broke it down to $8,000. Now, why this matters is, remember what the tax rates are on dividends. They're what they call the 0, the 15, or the 20. Those are the three rates. And those are percentages for dividends and capital gains. And what those rates are depends on where you fall into your tax bracket. So the lowest income brackets, you pay no tax on capital gains or dividends. Just only the very highest brackets do you pay capital gain tax or dividend tax at 20%. The vast majority of people would pay at 15%. So that's why that matters. And then, so for what we're going to look at for Abby, let's assume she's in the 15% tax rate. So she'll pay 15% tax on that. He pays 0 tax on the return on capital gain, and she'll pay 15% tax on the capital gain. So this is return on basis. So I call this ROC. This is return on basis, ROB. My bad. Okay, so dividends will pay 15. Return on basis is tax-free. It's like getting your investment back. And then the capital gain to pay 15%. So that's why that matters for Abby, and that's why the corporation has to keep a good record of what their E&P is, so that they can tell Abby, here's what this distribution is made up of. Okay, so that was question 15. Question 16 is a little bit more calculations. With this one, we've got Randell Corporation. They have accumulated E&P of $13,000. That's what they have at the beginning of the year. Then during the year, they have $84,000 earned throughout the year, and they say kind of evenly throughout the year. So roughly $7,000 a month for the year. And then Elizabeth and Jonathan are the sole shareholders of Rondell from January 1 to April 30. So for 4 months, Elizabeth and Jonathan were the two owners. on May 1, Elizabeth sells her share of stock to Marshall. So Marshall now is the new person along with Jonathan from May 1 to the rest of the year. So during the year, they make two distributions. $42,000 on April 30, basically the last day that Elizabeth owned the stock, and then another distribution at the end of the year on December 31 of $58,000 to Jonathan and the new owner, Marshall. So the question then in this situation is we have to allocate the distributions. So basically, as we do each distribution, we have to figure out how much came from current E&P, how much came from accumulated E&P, and then how much would be treated, if any, as return on capital. Okay, so let me do this in Excel with you and get to some clear space here. So let's start right here. And so we've got what I'll call current. Let's call it E&P. This EP for E&P. And then I have, I'll put this over here, accumulated E&P. And then I have the return on basis. Okay, and then from there, we've got our two distributions. So I've got the April 30 distribution. Remember, let me do that right. Okay, let me start from scratch. I pre-formatted this, and sometimes it comes back to haunt me. So that's the first distribution, and that was amount of $42,000. Okay, and then remember the December distribution, and let me format this, and that was $58,000. Okay, so I got those two distributions. So this is from current E&P, the $42,000 needs to be allocated to current E&P and accumulated E&P. And here's how I do this. So this formula I'm going to build here is pretty straightforward. Just simply take the $42,000 and divide that by the sum of the two distributions, the $42,000 plus the $58,000. Okay. If I do that, I'm going to put brackets around that entire calculation. I'm going to multiply that by the $84,000. And $84,000, if you recall, is the current year's E&P. We made $7,000 a month for the full year, so $84,000 for the year. And let me get this right. I need one more bracket here. Oh, I do not. Here we go. Okay, so we're at 35,280 is the amount. I had, in my previous example, I had one too many zeros in the 58,000, so I had 580,000, which wasn't working. So you get 35,280. And so the accumulated portion just becomes the balance. That distribution in total is 42,000 minus the 35,280. So I get 6,720. I do the same kind of thing I did here, and I'll put it right here. So I'll copy and paste, and then I'll adjust my numbers. So instead of 42,000 divided by the sum of 42 plus 58, I take 58,000 and divide it by those two. So right there, I still multiply that by 84,000, and I get 48,720. Then over here, what I do is I take the remainder, and I go 58,000 minus the 48,720. Now, however, I have to be aware of something. So at this point in time, a little subcalculation is that my accumulated E&P remaining is only 6,280. Because remember I had the accumulated E&P of 13,000, and that's what this column represents. And I back off what I already did of 6,720, it leaves only 6,280 left over. So that's the most I can do, 6,280 right here. And so the return on basis then becomes the difference between 9,280 minus the 6,280, so for $3,000. Okay, because kind of keep in mind the sum of the current can only be 84,000, and that's what this is. If I total these two up, I get 84,000. The sum of my accumulated can only be 13, because that's what they told me I had. And so I've now done a distribution above and beyond that. because I did a distribution of $100,000. The sum of these two is $100,000. And I had my current E&P throughout the year was $84,000, and my accumulated was $13,000. The sum of those two numbers is $97,000. So I dividend away $100,000 based on E&P of $97,000, so that extra $3,000 is return on basis. Okay, so basically that's what's left over. Okay, so that was that one, and that's probably the toughest calculation we have to make. So the good news is there's really not that bad calculations. That was definitely the toughest one. Okay, now for 17, Rover Corporation wants to transfer excess cash to a sole shareholder, Alicia, who is an employee. Alicia is in the 24% tax bracket. Rover is at the 21% tax rate because it's a corporation. Because Alicia's contribution to the business is substantial, Rover believes that a $25,000 bonus in the current year is reasonable compensation and should be deductible by the corporation. However, Rover is considering paying Alicia a $25,000 dividend because the tax rate for dividends for Alicia are so much lower. So basically, we have to figure out what is the best choice. Is Rover correct in saying the dividend's better? Why or why not? So basically, the question is, should we pay Alicia as a employee as $25,000 salary expense, or do we pay her $25,000 dividend? And so keep in mind she's the only shareholder. Okay, that makes this calculation easier. And they told us in her personal tax bracket she's at the 24% bracket. So she's not in the 37% bracket. That means the dividend rate she'll pay on any dividends received is 15%. So remember, it's the 0, the 15, and the 20. You only hit the 20 if you're in the upper tax bracket. If this said 37, then she'd be in the upper tax bracket and pay a 20% dividend. But because she's in a middle bracket at 24, she'll pay the 15% tax rate. Okay, so that's key to kind of just pick up on as you analyze the question. Okay, so let's go ahead and take a look at this. So for Alicia, and let's kind of look at this as a dividend. Of course, she'll receive $25,000. Her tax rate would be 15%. And then we do a little bit of math here. And she'd pay tax of $3,750. So what she'd have, that's basically her tax. And I'll call AT for after tax is what's left over. So $25,000 minus the tax, she'd have a net gain of $21,250. So the cash she can keep is $21,250 if it's paid as a dividend. Okay. Now let's just say it's paid as a bonus. So we'll put down this is as a bonus. Okay. So her tax rate then would be 24%. And so we'll do the same kind of math. I'm just going to copy and paste this over. Okay. So now she keeps $19,000. So basically, if it's a bonus, she receives that. Now, also keep in mind for Rover, though. Okay, so let's think this is all for Alicia. Let's think of Rover. This is the corporation. Okay. So remember, if Rover pays this as a salary, they'll reduce their taxable income. So if they pay it as a bonus salary, they debit salary expense credit cash with a 21% tax rate. So they're going to reduce their taxable income by this amount, $21,000, which is times 20%, which is $5,250. So in this situation, because Rover gets this 21% tax break by paying a salary to Alicia, she's better off actually taking the bonus. And this works because she's the sole shareholder. If there was multiple shareholders, it'd be a lot harder to figure this out because we'd have to take into account each individual shareholder's tax situation. But because this is just Alicia as the only owner, she should take a bonus because she does pay more tax on the personal side, but the corporation will save $5,250 of tax. And so she's okay doing that. So she definitely should take this as a bonus as opposed to a dividend, because remember, corporations, when they pay dividends, do not receive a tax break for that. And that's really the key with this particular question. Okay, the next one's question 18. And with question 18, it says here, Global Corp distributes property worth $850,000 fair market value, a $415,000 adjusted basis to one of its shareholders. The property was subject to a $230,000 mortgage. Shareholder assumed the Global was ample E&P to cover any distribution made during the year. What is the amount of the shareholder's dividend income on the distribution, and what is the shareholder's basis on the property dividend? So the key with this one is it doesn't matter what the basis is to the corporation. Okay, so its basis is $415. Okay, fine, doesn't matter. All we care about is the fair market value and the loan and the fact that they have plenty of E&P. So the shareholder will receive the $850 minus the $230 for a net distribution of $620,000. And that $620 then is a dividend because it says that they have ample E&P. Okay, so basically $850 minus $230, $620, it is a dividend to the shareholder. That's the answer to the question. Question 19, Quinlan has ample E&P to cover distributions made during the year. One distribution made to a shareholder consists of property with an adjusted basis of $150 and a fair market value of $90. What are the tax consequences of this distribution to Quinlan? And here you have to pay attention to the fact that this property has a built-in loss. Okay, so the basis is $150, the fair market value is $90. So there's a $60,000 loss on this property. And one of the distribution rules is if you do a distribution that's what I'll call upside down, there's a loss on it, you do not receive the capital loss. You cannot deduct that from your taxes. So if Quinlan wants to get this dividend to the shareholder, and we want that shareholder to receive $90,000, what Quinlan should really do is just sell the property and realize the loss. Okay, so sell to an outside third party. That would generate a $60,000 capital loss. Take the $90,000 cash received from that sale, and then pay a cash dividend to the shareholder. Okay, that's really what should happen. That way, Quinlan gets the benefit of the capital loss. If they do this and just do the property distribution, the basis received to the shareholder is $90,000. Okay, you receive the basis. There is a capital loss by Quinlan, but they cannot deduct that from their taxable income. Okay, so you cannot generate a taxable loss or capital gain loss by doing a property distribution. This does not work that way. Okay, question 20 is for Fargo Corporation. They distributed property with a basis of $260 and a fair market value of $310. Fargo Corp has sufficient E&P for its distribution. What are the tax consequences to Fargo? So now we're looking at the corporation that did the distribution. And so we're not looking at the shareholder, we're looking at the corporation. So the way this works is I'll just do this one for you in Excel. So everybody should hopefully see there's a $50,000 gain here. Fair market value 310 minus basis of 260, fair market value of 50. So right away off the bat, you have an E&P increase. E&P increase of 50,000. Okay, the 310 minus the 260. So E&P goes up for that, but then is decreased by the fair market value of the property dividended away. Okay, so now it goes down by 310. So the net decrease is 260. And that's the change in E&P. So the E&P net goes down by 260. The shareholder, remember, they receive the property at fair market value. So the shareholder receives a dividend of $310,000, assuming Fargo had plenty of E&P. And I think they tell us that it does. And it does say that. So the shareholder receives a dividend worth $310. And then Fargo's E&P goes down net by 260. Okay, question 21. is about Deerwood. And it says here, Deerwood Corp lends its principal shareholder Lafayette $500,000 on July 1. The loan is interest-free and payable on demand. On December 31, imputed interest rules are applied. Assume that the federal rate is 3%, compounded semi-annually. What are the tax consequences of this loan to Lafayette? So a portion of the chapter talks about constructive dividends. And basically the IRS is kind of on the lookout for ways that companies pay a quote-unquote dividend to shareholders that the company does not treat as a dividend. So in a sense, in essence here, what's happened is the company has given its principal shareholder, Lafayette, who by principal shareholder meaning he owns a majority share of the company, and receives $500,000 in loan. So they were going to impute interest on this. So loans always have interest on them. There's no such thing as an interest-free loan. And that stands for GAAP rules also. So for GAAP, it's the same thing. If an auditor showed up to a company and sees this kind of transaction, they would say, there's interest on this. There should be interest, received by the company because the company made a loan. It should be receiving interest income on that. So they would impute interest and do that calculation. And the IRS is saying the same thing. So essentially, a loan's been given, and Lafayette should be paying interest on this. Okay. So here's the way it works. And I'll do what I call the PIT method of interest. And by PIT, I mean principal times interest times time. So if you ever heard that method, the PIT method of interest. So principal is $500,000. Interest was 0.03. And time is based on a year. So in this calculation, time is based on a year. Well, the time component was half a year. So just think 6 months out of 12. And that turns out to be half a year. So interest is principal times interest times time. I get $7,500. Okay. So here's how this works. So the company, the corporation, is called Deerwood. Okay, and Lafayette's the principal. So in this example, this is basically a dividend to Lafayette. Okay, so this amount is paid by Lafayette to Deerwood in the form of interest. And so Deerwood basically then returns the amount back to Lafayette as a constructive dividend. So for Lafayette, he's going to treat this like a dividend. Okay, and now he didn't really receive the cash though, right? So no cash is changing hands. But for tax purposes, we're going to look at this and go, hey, that's a dividend. So Lafayette's going to have a taxable dividend of $7,500, even though he never actually paid the money, received any money on that. He's got the $500,000, the principal of the loan, that may or may not ever get paid back. But basically, we're saying there's a constructive dividend of $7,500 of interest that he didn't actually pay. So he's going to have to pay tax on that based on whatever his personal tax rate would be. And then for Deerwood, Deerwood basically then has interest income of $7,500 even though it never received the cash. So now its taxable income will go up by $7,500 and pay tax on that at the 21% rate. So basically, the IRS is saying an interest-free loan from a corporation to a principal shareholder or to any shareholder is really a constructive dividend, and the imputed interest becomes a dividend to the shareholder, and that becomes dividend revenue to the corporation, even though cash never changes hands. Okay, the next one is 22, and this is for Euclid, and each of these two situations is independent. And this deals with receiving stock dividends. And stock dividends are treated differently if they are taxable versus non-taxable. And they'll tell you that in the problem. So don't worry about figuring out if a stock dividend is taxable or not taxable. They'll help you figure that out. In this example, they're telling me it's non-taxable. So Euclid bought 500 shares of common stock 5 years ago. And the price was $50,000. This year they received 20 shares as a non-taxable dividend, what's the basis per share after the event? So obviously we can all do the mental math and go 50,000 divided by 500 is $100 per share. We can all figure that out. But now we have 520 shares. So all I do, it's really simple, is I have the 50,000. Okay, that's what I have. I had 500 shares, but they give me 20 more. It's non-taxable, and that was the key. So all I do is I take the original 50,000 cost, divide by 520, and my new basis is $96.15. So the old basis was $100 per share. Now it's $96.15 per share. Very simple. The next situation, they say that Euclid receives a non-tax preferred stock dividend of 20 shares. The preferred stock has a fair market value of 5,000. The common stock on which the preferred stock is distributed has a fair market value of 75. Okay, so I've got two things that I own. I've got fair market value of common, and I've got my fair market value of my preferred. Okay, so the fair market value of my common was 75,000. They just gave me that number. And on the preferred, it was 5,000. So the sum of the two then is just 80,000. Okay. So now all I'm doing is I'm allocating that to my basis of 50,000 because that doesn't change. Okay. So it says right here up. So we still have $50,000 worth of basis on this. Okay. So I come back to here and have to allocate that. So basically my basis of common and my basis on my preferred is this. I take the common and I take 75,000. I divide that by 80,000. And I multiply that by 50,000. Okay, I gotta get my brackets in there to do this right. Okay, that's my allocation. I do the same thing here. Only this time I'm taking 5,000 and dividing by 80,000. And I sum those together and I get 50,000. Okay, so that's how we do that one. So the key is that it was non-taxable. Okay, question 23. Actually, we're not going to do 23. I'm going to do 24. That's what's a better one to do. So 24 will be the last one that we do. And it says here, the start of the current year, Blue Corporation, a calendar year taxpayer, has a cumulative E&P of $100,000. Blue's current E&P is 60. At the end of the year, it distributes $200,000 to its shareholders, Pam and John. Pam's stock basis is 11, and John's is 26. How is the distribution treated for tax purposes? Basically to each Pam and to John. So the key here is that they got total E&P of 160. Okay, so you're going to pay out $200,000 worth of dividends or distributions. So it's safe to say right away, of that $200,000, 160 is dividend. Okay, that's 40,000 left over. So it's 40,000 left over that we have to deal with. And so 20,000 to Pam and 20,000 to John. So take a look at the 20,000 for Pam. She's got a basis of 11. So that 11,000 would be a return on basis. And that means that 9,000 left over would be capital gain. Okay. So for Pam, 80,000 dividend, 11,000 return on basis, 9,000 capital gain. Okay. And then for John, again, 80,000 dividend, but his basis is 26. So 20,000 then becomes return on basis, and his basis left over is 6,000, and Pam has no basis left, and John's got a $6,000 basis. Okay, so that's how that works on that one. Just the key is there's 160 of E&P, but they distributed an amount above that. Okay, hopefully that all made sense with Chapter 5. As always, if you have questions, just let me know.